Markets, we all know, very topsy-turvy at the moment, and I guess any investor is trying to kind of look for patterns, to try and kind of look for where things are going, to try and position themselves. Somebody who thinks a lot about this, that's his job, Jonathan Davies. He's an economist and wealth manager, and he produces a booms and busts report, which is always complete with charts to see what's going on. And he says there is good news and bad news about these markets at the moment. Jonathan is on the line now. Good morning.
Morning, Nigel.
Should we take the good news?
The good news is that after a 20-25% fall in major markets over the last several months until a week or so ago, we're having a period of respite, whether it's a few weeks or maybe a couple or even a few months. That's the good news.
So I almost don't dare to ask, what's the bad news then?
The bad news is, depending upon your point of view, of course, and depending upon whether or not you're prepared, we're in a bear market. 2001, 2002, 2008, 2016. The trend is down. The trend has been down in both developed and emerging markets for shares, of course, not government bonds, which are doing extremely well. The trend is down since last year, and the trend continues until it is no longer. As I say, we're having a period of respite. In 2008, there were several 1,000-point rallies in the Dow Jones. We've already had two this year. We're only in February. But the trend is down, and people need to be prepared for it.
I'm just interested in your reasoning. Now, you sound like a reasonably cheerful chap, but the reality is you are a little bit of a bear. You tend to, over recent times, you've taken a relatively gloomy view, though it has to be said with some justification looking at what actually happened. So what makes you say that, we are in for this bear run?
Well, first of all, put it in perspective, I write the booms and busts report because there's lots of good things happening as well. But if we're focusing on shares, as clearly that's what you want to do, I think the two major risks out there are clear and existential. One is global banking. It's as bad as 2008. All you have to do is look at the share prices of the major US and European and Japanese and Chinese banks. Deutsche Bank, for example, although it's just one of many, last week, we're talking about the largest bank in Europe. Its share price was lower than the lows in 2008. And that's after years of bank bailouts, of zero interest rates, of trillions of dollars of QE, and Deutsche Bank's share price was lower than the lows of 2008. So banking shares in a global economy based on debt, if banking shares were up, we could basically say we're okay, but they're not. So we can't say we're okay. And the second thing is the Chinese currency, the yuan. The yuan has devalued roughly 10% over the last year and a half. That has, of course, exported deflation to the West because it costs us less to buy stuff from China. And given the rate of attrition of their foreign exchange reserves, it's entirely possible that there could be a huge devaluation in the yuan over the next year. It could export, wait for this, a Poseidon Adventure-sized tidal wave of deflation on the West, where you can imagine what that will do to equity and property.
So it's not enough that we have to deal with the prospect of oil prices lower for longer. We also have China exporting deflation. So it sounds like we'll never get back to these inflation targets that the Western central banks have.
Well, good luck to them. I love myself. I love deflation. I love the fact that my living costs are lower, my business costs are lower. I think these central banks are both mad and bad that they are desperate to have us pay more for stuff and services. It's an absolute outrage as far as I'm concerned. And the sooner we just get real and let the market take over rather than have these Politburo guys in ivory towers impose stuff on us, the better.
But I guess the concern is that for savers, deflation is really bad. They're basically eroding everything they have in the bank.
Deflation is only bad if you're indebted. The fact is, the bulk of the population either have small debts or no debts. So actually, deflation would be beneficial to the economy overall. Not in the short term. I mean, clearly we have an economy based on debt, which is in itself an outrage. But in the long term, deflation would be brilliant for our economy. I mean, look at Switzerland, one of the strongest currencies in the world, one of the strongest countries in the world, and they don't have inflation.
Okay, so, right, you've painted this scenario for us. Let us take you at your word. It's at times like these, then, when there's a pause, that people are going to need to switch, aren't they, out of certain assets they deem to be risky. So, just talk us through, in terms of typical portfolio, what this sort of pause, what opportunities it presents, and what sort of switching you think would be sensible.
Well, absolutely. This is what really matters. This is why I have great optimism, but you have to take action. I mean, as I say, we've already had, in the Western markets, some 20-25% off in shares. When you go to China, the Chinese market's down nearly 50%. However, as I say, indeed, we're having a bit of respite. This is the opportunity to alter your positions. Most people's portfolios are heavily slanted to shares, corporate bonds, and commercial property, and they may have a minority in quality government bonds like gilts, German bunds, and US Treasuries. As far as I'm concerned, they should be taking this opportunity. We've had 100 points already up in the S&P. We've had 400 points or so in the FTSE. We should take this opportunity to use it as a selling opportunity to significantly reduce out of what we call risk-on assets, as in shares, corporate bonds, and commercial property. And instead, we should be moving into quality government bonds, particularly, in my view, US Treasuries, because you're going to get long-dated US Treasuries. That is, you're going to get 2.5-3% interest paid for by the US government. You, in a deflationary world, you should see the price of government bonds rise, so you get interest and a capital growth, and on top of that, for British investors, the pound looks as if it could weaken further in the medium term against the dollar, so you'll also get the currency benefit as well. So move heavily into government bonds for the next 6, 12, 18 months.
Okay, well, that's what Jonathan Davis is doing, economist and wealth manager. Of course, that's just his idea. There are very many ideas out there in the market, but certainly a bit of weekend reading his boom and bust column certainly takes some beating and a few charts to go with it. Thanks very much indeed for joining us.